Someone has mentioned to me that the sign of a successful gathering is the communication amongst its participants. So I take it that this is successful so far. There seems to be a lot of interaction, which is great. Without any further ado, I would like to introduce our next panel. And I would like to introduce its chairman, who has just recently arrived a few minutes ago. So we're very pleased to have him, especially since I will not have to be chairing the panel. So I'd like to introduce Professor Acharya, who's a professor of finance at New York University. And our other panel members, Aerdt Houben from the Dutch Central Bank, in charge of financial stability. Well, I would say one of the many people, I'm sure, working on financial stability within the Dutch Central Bank. And also Professor Pieter Krahnen from the Goethe University in Frankfurt. So I would like to ask Vero.
Thanks, Brenda. It's always a pleasure to be here in Amsterdam. My son, my wife used to work with Amsterdam Institute of Finance, and so my son, for the longest time, thought that every plane that leaves goes to Amsterdam. And so yesterday I asked him, where do you think I'm going? And he didn't know where I'm going, but he said, you must be going to Amsterdam. So it's always a pleasure to be here. It's a great city. I'm always happy to walk here and so on. But let's get started. So we'll keep it brief. I won't go into long introductions. I'll hand it straight over to Aerdt, who's going to present some slides. And so I'm going to talk about his proposal on cocoa bonds, bail-in kind of debt. Jan will then share his thoughts on these kinds of instruments and their limitations. And then I'll share my thoughts on limitations of almost everything that we do. So let me hand over to Aerdt.
Thank you, Vero. Given these chairs, I think I'll stand. Over the past 20 years, the world has really changed fundamentally. And what I want to do here is to present some reflections on this and to do that a little bit more fact-based than the session we had, the first session today. So I want to give you a number of facts on why the world has become more complex, more interconnected, more financial, and more systemic than it ever has been before in the history of mankind. So if that sounds dramatic enough, these are my three main messages. I have three main messages. The first is that systemic risk has risen dramatically in the past 20 years. And I will try to illustrate that. And I'll try to make a point. It's a very important point because this is a structural change in the world economy and in the financial system worldwide. So this is not something cyclical. It's not something we've seen before. It's something new, and we have to deal with it. The second thing I'll try and do is to give you some flavor of the fact that there has actually been a very wide-ranging and very far-reaching policy reform to try and address this new problem. And we've only just begun tackling it. And I really don't think we're anywhere near where we should be to feel comfortable. So my third message is that very much remains to be done. What I want to try and do is not to get stuck in all sorts of intricacies and all these very inspiring details which Basel III and other of the solutions are rife with, but to give you the big picture. And let me just start with the big picture over the past 100 years. What I've done here, and please look at the two red lines. What I've done here is I've mapped out the development over the past century in the Netherlands of the capital of our banking system. So all our banks, what sort of capital ratios did they have? That's the left graph. And you see that 100 years ago or 112 years ago, our banks started with capital ratios of loss-bearing capacity close to 30%. And in 2008, which is when basically we learned that we'd gone too far in this direction, we had a leverage ratio of about 3%. And we're now really struggling And you can see it just petering up again, and we've risen it to about 4% now. And we're extremely proud because we're getting there. This is a non-risk weighted balance sheet. And for all the nice words spoken about the Swiss banks in the first session, if you look at the Swiss banks, it's comparable. So Credit Suisse and UBS, they also have a gross leverage ratio of around 4 now. But of course, they advertise with something close to 20. But I would do that too if I was Swiss. The right panel, the right line, is the liquidity coverage. So to what extent do banks have liquid assets to cover their liquid liabilities? And again, 110 years ago, banks had close to 2 times the amount of their liquid liabilities in liquid assets to fulfill their possible immediate liabilities. And that declined to about 60, and it's now, we're very proud of the fact that it's trudging up, and it's now close to 70. So this is a big picture. This is very important, because the left picture, the one on the capital, is the one that in the previous panel discussed. That's what addresses fundamental risk, fundamental uncertainty. That's what addresses the unknown unknowns. If I ask you, if I look back to see what statements were provided on the 15th of September 2008 on Lehman, and I mapped out what did the main economic commentators in the Financial Times, Martin Wolf, Wim Buiter, he was not at Citi then, but he wrote a column. What was their thinking at that point of time about the systemic risk related to Lehman? They didn't really know. And they thought that on the balance of their judgment, Lehman was not systemic, and public authorities should stop supporting non-systemic banks. That was the main thrust of the editorial of the Financial Times on the 16th of September 2008, that it was a good move by the US authorities and, again, the rich authorities to not support Lehman. And if I were to ask you now on Greece, whether Greece is systemic, then I think we would probably have the same sort of difficulty in establishing in a forward-looking, balanced manner whether Greece is or is not systemic. This is, in essence, a fundamental uncertainty. We don't know, and we cannot add a quantifiable measure to certain events in the future. And what do you do when you don't know? You limit your leverage. And that is something that applies to banks, so we have to get the capital ratios up again. It applies to households, and it applies to governments, and to a smaller extent to private companies. But that's something we're going through now, and that's the reason why this recovery is so anemic, because everyone is deleveraging at the same time, because we all overshot in the pleasure of increasing our leverage over the past 20 years. So what's the policy response? Higher capital, and we're introducing liquidity requirements for the first time. Very simple, big picture. Second issue of big picture. What struck me in the introduction in the first session is that there was a lot of debate on complexity and on interconnectedness, but not just simply on size. And this is a structural dimension of a change in our society. We've become a very deep, financially deeply involved society. These are the balance sheets of the top 50 banks in the world, divided by the world GDP. And as you can see, it started, the nominal total of these banks was less than 1 trillion in 1970, and it's close to 65 trillion now. But that's not really an important measure, because there's a lot of inflation and a lot of things disturbing this picture. So what you should look at is the red numbers. What is the balance sheet of these top 50 banks in terms of world GDP? Used to be about 15, now it's close to 100. So the message here is that when something funny happens in one of these big banks, it's really going to reverberate throughout the world GDP, because the production, the economic production that is sustaining these financial giants has gone out of kilter. So we want a greater buffer to have these institutions to be able to rely on. So what are we trying to do here in terms of policy? There's a capital add-on specifically for the systemic institutions. In the Netherlands, we've put that at 3 percentage points extra core tier 1 capital on top of the baseline capital requirement, simply because a bank is large and it's potentially dangerous for the stability of the economy. The second thing we're asking these banks to do, and we're just starting to do this because it's an extremely difficult process to go through with the banks, but it's to make them more easily resolvable, so that when it goes wrong, it does less harm. So we're trying to make the structures more simple. We're trying to make branches subsidiaries. We're trying to reduce the cross guarantees within complex financial institutions, etc., etc. We're trying to make them more easily resolvable, and we've given ourselves, or the Ministry of Finance and the Central Bank, resolution powers to be able to step in an institution in a much earlier stage than used to be the case before the crisis. Andy Houben has a very nice chart. We don't have a nice chart yet because we don't have the data. Now, it's surprising when you step in a plane, and some of you may have come from abroad, and you step in a plane and you go to Amsterdam, the amount of technology that knows exactly where you are and that makes sure that you arrive where you need to arrive safely, and then you can step into your taxi and come here, is so vastly more developed and more reliable than what we know about the interconnections within the banking system. So it's quite deplorable that when the Americans made the decision on Lehman, they knew what the counterparties of Lehman were, but they didn't know what the counterparties of the counterparties were. So they didn't know how it would all fit through. The other thing that they didn't know is that because they were looking at all the individual institutions in the US, that a lot of these individual institutions had common exposures to one party, which was AIG, because they only looked at the individual institutions. Whereas when you look at the network, suddenly you see the concentration points, the nodes which you need to address. So what this basically is, these are the banks that took part in the EBA stress test earlier this year, and it depicts all the banks in Europe that have linkages with each other, substantial cross-border linkages. And basically what it does, I think it's the red arrows denote those that have significant exposures on Greece, Portugal, and Ireland. And the purple ones are those that are exposed to Italy and Spain. And basically it shows that if you start trying to unravel this, you have systemic risk. So what are we doing about this? Starting this year in Basel, the BIS is starting to collect data on the network. So all the major banks are reporting to Basel on their main counterparties, their main maturities, their main sources of funding, the main sectors to which they're being exposed. So we're really getting the technology of understanding systemic risk and understanding where the vulnerabilities lie to a much higher level. The second thing we're doing is within Basel III, but I promised I wouldn't get into the intricacies of the technicalities. Within Basel III, we're charging more capital for large exposures. And there's one issue here, which is the exposures on sovereigns, which, bear with me, we'll come back to that because that's a big problem. Okay, let me just see. This is another dimension of systemic risk. And this is the dimension, what do we not know? So there's some things that we know, and this is something that we know that we don't know, and that's the shadow banking system. So it's not an unknown, but this is a known unknown, so we decided, all right, let's try and drill down and get a better feel for the shadow banking system. And in the first assessment that we made, we found out that it had grown faster than the banking system and faster than the insurance companies and pension funds over the past 15 years, and that it is now about 165% of GDP. And the Netherlands had a huge share in this, but we looked more deeply into this in the Netherlands, and we are only looking at those elements that are really systemically relevant, so money market funds, structured specific purpose vehicles, hedge funds and such like. And if you take those, then the share of the Netherlands is significantly smaller, but it's still about half the size of the banking system in the Netherlands. So the banking system, we have a shadow banking system in the Netherlands, which is about half that size, and it's generally unregulated. So what are we doing about that? We're trying to get them to report, and we're trying to get a better feel for the leverage in the shadow banking system, and we're evaluating the regulatory scope and whether we should start to bring some of these parts of this sector under the regulatory umbrella. Okay, so what if we, the process, the main body that is trying to oversee and to coordinate this agenda internationally, and John referred to this earlier. It used to be the Financial Stability Forum, but on the back of the crisis, they were able to upgrade themselves to a board, from a forum to a board. It's now the Financial Stability Board. They're located in Basel, next to the BIS, and they're coordinating the international agenda. Clearly, we're making some progress on capital and liquidity. Clearly, we're making progress on resolution powers within countries. We're starting to get a better understanding of the shadow banking sector. We've done quite a lot of work on the market infrastructure, particularly on central counterparty clearing for derivatives, and for the OTC derivatives, increasing the collateral requirements and such like. We're trying to converge accounting standards. That's an extremely tall challenge, and to make these accounting standards less cyclical, because that's part of the problem as well. We're reducing reliance on credit rating agencies, while at the same time recognizing that they're actually quite an efficient part of the financial system. We're trying to make compensation practices more prudent. We could spend hours talking about that. I'm sure there are many of you who have strong feelings about this. And we are developing new macroprudential frameworks and macroprudential tools. I think it will, the future will tell whether we have the courage to not only develop them, but to implement them as well. I have some hesitations whether we'll cross that bridge, but perhaps the counter-cyclical balance is the first element, but whether we'll go very far beyond that remains to be seen. Okay, then one last analytical graph, because I know some of you like these things. This is a graph, a measure of systemic risk. And we have the line in the middle is the zero line. Above that line is banks. Beneath the line is governments. And what is measured here is the coexceedance in a certain large deviation in the CDS premia, the price in the markets of risk for banks on the top half of the graph and governments at the bottom half of the graph. And it's been measured according to what could be an indicator for systemic risk when this volatility is more than 8 basis points in a day. And the amount of banks that have these huge changes in a day depicts how far it goes to the 100%. And basically what you see is that until about 2007, banking was a pretty safe place and a bit of a dormant place to work. Then it became exciting and systemic, but it was only limited to banks. And starting in about 2009, banks and governments got into a stronghold together, and clearly they're both extremely systemic now. And this is just an illustration to say that systemic risk is still here. We are this is Europe. Sorry, this is the euro area, I should say. So these are the euro area governments, and 24 internationally active euro area banks. And basically, there's still an immense amount of systemic stress out there. So this underlines my third message, which is, let's not think we're anywhere near where we want to be, but there's a lot more to be done. So let me just end with a few things on the final challenges which we have to face in the coming years. The first is we really have to develop recovery and resolution plans and ensure the resolvability even of the larger financial institutions. This is a tall order, but if there is mismanagement or faulty business models and strategies in the banking system, it would be very strange not to allow these institutions to fail, but we have to create the possibility for these institutions to fail. And starting in 15th of September 2008, we've become very hesitant to allow them to fail, but we got to tackle this hesitance. The second thing is that, and I know this is subject to a lot of debate, and the next panelist will undoubtedly talk about this, but there is a case, certainly in the case where investment banking is sizable, to separate it from retail banking, which has many more public good dimensions to it. Third, we need bail-in instruments for resolution and even to avoid resolution, so in recovery plans. And these bail-in debts, I fully agree with the proposals by the Krahnen report, but the next speaker will undoubtedly highlight those. We've got to cut the link between banks and sovereigns, and this is something we have to do with some priority. It's the question always, when do you do it? And if you talk to the Spaniards now, they'll say, don't do it now, because our banks are the only people, the only institutions that are still willing to finance us, and if you don't allow our banks to do it, then no one will. So there's a difficulty there, but we'll have to introduce risk weights for our sovereigns, and we'll have to introduce concentration limits for the extent to which banks can invest in their own sovereign. Banking union in Europe, I won't say too much about that, other than that that will really help spread the risks within Europe. And if you look at Europe as a whole, Europe is extremely solvent. It's much more solvent than most other developed areas in the world. So if we spread the risks, we can certainly bear them. Finally, macroprudential policy. As I said earlier, I think we still need the big courageous step to do it. We've been talking about it now for 3 years, but it's quite astonishing to see that there hasn't yet been any advanced country central bank or ministry or supervisor that has really made a lot of headway with actually implementing this new policy toolkit. So I'll leave it there and.
Okay, thank you for inviting me. So I want to stress what I will present is two, I think, important elements in this newly published Krahnen report. I was one of the members of that group, and so I want to present it and also defend it in discussion if that is necessary. And I think much of what I have to say relates very well to what we heard in the first panel, and also what, of course, has been said right now. And let me start with a minute on the basic, let's say, crisis narrative, the view that the Krahnen Commission is taking on the crisis, because whatever the proposals will be later on in this report have to be based on some, let's say, reasoning why it came so heavy and so badly, and what were basically the main problems that we have to solve. And in a very brief nutshell, I would say the most important topic that we raise, and of course this is very much concurrent with what we discussed today, is excessive risk-taking by financial institutions plus systemic risk. And the issue is that we, in this report, we talk a lot about systemic risk. Of course, we had tried to understand how it is measured and so forth in the first panel, and in a way the upshot was difficult to measure, difficult to understand even. We don't know much about that, and we conceded the same thing. But we also discussed one issue which has not been discussed in the first panel, and so I want to mention it here, that is the interrelationship between the existence of systemic risk and the existence of one player in our financial markets that has almost not been mentioned so far, which is the government. And the sheer fact that we have a government who might intervene and who predictably will intervene, of course changes the behavior of many in the industry. You might say systemic risk and government intervention is exactly the same thing. Yeah, maybe this is what we have learned. But in a way, understanding why governments intervene, how they intervene, and how actors in the industry anticipate this behavior and basically bet on this behavior, is part of the emergence and let's say the extent of systemic risk that we observe everywhere. So this is our main, basically the result of our analysis. I want to give you one example that relates to the presentation we just heard. CDS markets. What do CDS markets really tell us? And there is a widespread belief that CDS markets tell us something about default risk of institutions. This is also true for corporates in general. That would be my claim, not true for banks. So the CDS of banks do not tell us whether a bank is near to default or not, but it basically tells us what's the likelihood of a bailout happening for that particular bank. And this has to do with its degree of systemicity ex ante. So if we think this bank is very systemic, we will not see high CDS spreads for that bank, independent of the risk that it takes. Right? So this is one example where the market is exactly not working. And this is only true for the financial industry. It's not true for anything else in the industry. CDS markets work well, market discipline works well, not in banking. And that's all is a conundrum. Systemic risk as the result of interconnection, government intervention as a result of that interconnection, if it materializes, affecting the economic underlyings. And third, markets that respond to this, understand this logic, and price accordingly. And of course, give wrong price signals. So if we think of a CRO of a bank as being a pilot who looks at his instruments, and some of these instruments, and most of these instruments, are actually prices, then these instruments are out of range for some of these markets. For instance, CDS markets. So our observation would be that CDS markets cannot be used for predicting anything reasonable in the financial industry. At least not now. Why not? Well, because we have this too big to fail problem not solved. So in a sense, if we want to get back to what was mentioned in the first panel, what was mentioned by both of you, namely have market discipline reappear as an instrument in which we can trust, we first have to solve too big to fail in a credible way, with credible default risk being attached to individual banks, no matter how large. We are back at proper pricing, and we can rely on price signals to have some behavioral impact. So this basically I would say, the philosophical stand of the whole Krahnen report. How can we get there? And I have this nice quote from Sir John. I don't know whether he's still here, but I think he has. You said this: you have to stand behind the whole bloody lot. Right? Wonderful sentence, which is exactly the difficult situation the government is in, which basically markets fully understand. Right? So you can never trust the price the day before you have to stand that fully bloody lot. That would give you any indication about the true default risk that's being there. All right, so let me jump from there, basic philosophy, repair, market discipline, to the two main suggestions, in my eyes, the two main suggestions that the Krahnen report is delivering. The first one has to do with risk-taking overall in the system, and it basically addresses this separation issue, but I think in a way which is quite different from what we have heard and seen so far, both on the American side as well as in the UK side, because the suggestion in that report really tries to not to look at investment banking versus retail banking, but only to look at trading activities. And in this respect, not simply at prop trading, which would be the US approach, but at prop trading plus market making. And of course, the insight is that we could gain from the discussions around the Volcker rule that you cannot distinguish prop trading from market making. If you want to do it, it will in some sense be artificial, and the way around this regulation is so evident and clear now that I don't think that the Volcker rule will have much of an effect on true risk trading in trading books. But that's why we emphasize the entire trading activity, as soon as it has a certain minimum size, has to be separated. Why separated? Separation, in our suggestion, in our proposal, forces the trading institution to come up with its own funding. That's the main story. Why is funding so important? Well, not only that all Basel III risk rules will be applied to the trading section separately, but also the funding costs are, that's at least we expect, the funding cost for the separated trading unit to be higher than the average funding cost that is now often used in banks. Now, we don't know exactly what the transfer pricing model is that investment banks are using to price their funding of the trading book. It might be just as intelligent as the market would put it, but it's also possible that they just use average pricing. And there where we could check, we found average pricing. But it's only a very, that's only anecdotal evidence in a way, not hard evidence. But as long as you have this average pricing of the funding of trading, of course, the universal banking model is very attractive to build up large trading books because the funding is basically pegged down through the deposit business. And this average funding price that they might use in their own calculations drives artificially the profits up in the investment banking section. Actually, almost you are basically free to show any profit you want on the investment banking side as opposed to the commercial banking side in these buildings. And then if you have different sorts of bonuses applied to different sorts of businesses, you might have an incentive to do so actually. I don't claim that this is the fact. I just say that these are incentives. And in that sense, the separation would eliminate these incentives, at least to the extent that is possible through these market operations. That's the first, I think, idea that is presented in the report. The second one has already been basically brought up by Viral when he talked about Theo's presentation, that is to focus on bail-in debt. And the main idea is, of course, here to make too big to fail possible. We have, as I think, pretty good recovery and resolution legislation that is currently under scrutiny at the European level. This has all these built-in instruments like bail-in debt, etc. But nevertheless, when we look at, to give you an example of Germany, where we have almost the exact same resolution and the restructuring and resolution legislation as is now suggested for Europe as a whole, we have never seen the application of this legislation. Actually, that legislation in Germany was made just before Westdeutsche Landesbank almost defaulted and had to be rescued. And this rescue was not done under the rules of that new legislation, but it was done by the state. And if you go further and ask why was WestLB basically protected by government money rather than by creditors' money, you easily find the solution. And the solution or the answer is that many of the creditors of WestLB were other banks, actually savings banks in this case, but other banks. And the fact that other banks are the most important creditors of banks would imply that the regulator cannot impose the loss on their creditors without fearing that it actually causes exactly that systemic risk that it wants to avoid. So in any sense, you said you have to break the banking from sovereign risk price, where that's the way to do it. That's at least the suggestion in this proposal. Come up with debt that is truly and credibly, in a way that can be anticipated by markets, bail-inable. Now, what does bail-inability mean? In the proposal from the Krahnen Commission, it is said the bank should have a certain layer of debt, and if you would follow the Swiss finish, the Swiss model, it would be about the size of equity, which is on top of what the bank has now in equity. You would have a layer of debt, and this layer of debt is by construction bail-inable. Now, what does it mean by construction? Well, the main principle will be this bank debt is dedicated for bail-in, so every investor who buys it knows that this is the case. Coupon will be high, just by implication. And second, it cannot be held within the banking system. So basically, we sometimes call these bonds anchor bonds, and I now draw on a formulation that Arno Boot was using in the morning to anchor the banking system outside itself in some other part of the economy or of the society, such that when there's a hit being exerted on the system, it will not work back into the system, but will somehow be captured outside. That's the main idea. And I think these two are the ones that hopefully will get the due attention by now the legislator, because this is only a proposal that we have been writing. Interesting, we have a small section in our report which has been immediately taken up by the press, so it seems to sell well, so I tell it. It is that we said, well, this bail-inable debt should be a good way to compensate bank managers. So rather than giving them stocks or stock option or anything like that, or even cash, you should do the bonus payments in bail-inable debt, which has to be held for some time, right? Which is the first in line if losses have to be allocated. So that was taken up quickly. All right, I think I finished. That were the two main ideas, I think, that are in the report, besides several others, which I don't mention now. But I think those are the best ones for our discussion here. Thank you.
Thanks, Jan, for these great comments. So I have two sets of points to make, and one is going to be very closely related to Jan's ideas for bail-inable debt, but I'm going to suggest that we apply the same idea to sovereign borrowing, and I'm going to come back to that. So the first point I wanted to make was that, that there is actually a political economy of bank regulation that we have sort of not paid much attention to, and perhaps attributed quite a bit of, I would say, blame or attribution on the crisis to the private sector. And I think one thing that is astonishing about the charts that Aerdt showed was that it is true that the bank capital and the bank liquidity have been coming down quite substantially over the entire century. But in some sense, why the crisis was most, in some sense, surprising and disappointing was because it happened in a period from 1988 when bank regulation had actually taken quite a deep root in the financial system. We had Basel I, we had Basel II, we had a lot of talk about making the banking system grow strong. And I think the reason is because the banking sector was expanding, as I've said already, precisely in those areas where the capital requirements would actually look low. So there was more than $1 trillion of assets sitting in the shadow banking system of special purpose vehicles. Why? Because banks had given them lines of credit which were less than 365 days. Why do you give them lines of credit which are less than 365 days? Because you don't have to hold capital against 364-day lines of credit. Why were banks holding residential mortgage-backed securities? Because AAA-rated residential mortgage-backed securities required only 1/5 or even less of the capital requirement of a AAA-rated CLO, for example. So in our capital requirements, we have told the banking sector, go and lend to residential mortgages. Don't go and lend to corporations, all else equal, because you're going to have to hold 5 times or more times the capital requirement. So there's a sense in which it is felt often that it is the Asian central banks, Asian regulators who are micromanaging the credit allocation of their economies. And if anything, my view is exactly the reverse, that by setting these very static, non-risk-dependent weights, which don't change too much, the Western economies, since the Basel requirements have come in place, have effectively micromanaged the credit allocation in their economies. Why has no one objected to this before? Because housing is a nice asset to finance. Governments like it. It creates a lot of growth. When housing sector grows, there's a lot of other asset sectors that benefit. So when I go to a house in United States, I'm just stunned with how many gadgets are there when you own a big house. You have to have a ladder, you have to have a lawnmower, you have to have 2 or 3 big cars because you have big garages in order to keep this. So when you boost your housing sector, you immediately boost several other sectors of your economy. There is jobs, there is short-run growth, and everything looks nice, even if it is frothy when this happens. Why are the sovereign risk weights very low? I think it's because it makes it cheap for sovereigns to borrow. I think there is no other explanation, I think, that one can provide for this. And it's true that historically, some of these assets might have looked safe. But, you know, in some sense, if the whole idea is to make capital requirements risk dependent, then why anchor these risk weights into history rather than having a more dynamic or time evolving response to this? So a lot of responses have been proposed that we need to make things simple. We can use the simple leverage ratio, as Andy Haldane has been recommending, and some other academics have been recommending since a while. It's been proposed that we should have loan-to-value restrictions in the housing market. And I think all of these things will possibly make things simpler, but I'm worried that they don't really actually solve the problem, because now once you use a simple leverage ratio, the Lucas critique is going to apply to the simple leverage ratio. How is it going to work? Because a lot of things can now will switch into derivatives-based activity. Why? Because a simple leverage ratio takes no account of the derivatives risk of your book. And so I think that maybe what one needs to do is to have a more holistic sense of understanding of a balance sheet of a bank or a bank holding company, rather than sort of have this tick box rule that if your risk-weighted assets are right relative to your capital, if your leverage ratio is right relative to your capital, everything is going to work fine. I think one approach that might work, that some central banks in Asia seem to have adopted, which I seem to like, is that they actually revise sectoral concentrations of lending. So you may have assigned a low risk weight to housing historically, but if in 2006 your entire banking sector is loaded up on the housing asset, depart from the Basel rule. And simply say that going forward, all loans which will be made to the mortgage asset class will have either a higher risk weight or they will have a loan-to-value restriction. Why? Because historically, this asset class may have been safe, but now the banking sector has loaded up quite a bit on it, and there's a very high concentration risk. It's just a simple way of saying that just because my past rules are looking fine on the balance sheet of banks, I'm not going to assume all is okay. Okay, that's one point. The second point I wanted to make is that I think there is, just the way there's a problem of leverage of banks, I think there is also a problem of leverage of sovereigns. And why? Because I think sovereigns also like to have leverage. They like to spend. They like to do housing finance. They like to create jobs if private sector is not creating enough jobs. And why do they like to do it? Because there are election to election concerns. So, you know, ultimately governments are run by agents. They have an objective function. And I don't see why we should assume that a government's objective function is aligned with a central planner maximizing the whole long-run welfare of our economies. I think that would be a very strong assumption that certainly seems violated in data every election. So there's a very interesting proposal here called Bruegel. It's from this Bruegel think tank in Brussels. And the idea is very similar to bail-enabled debt, which is create two kinds of bonds, red bonds and blue bonds. One class of bonds can be held by banks, by the domestic banks of the country. And they will be backed through a central pool of funds. Let's say if we are talking about Eurozone, then there is a central pool of funds that will be created for backing these bonds. So there is some mutualization of risks as far as these, let's say the first set of bonds, red bonds, go. And now, of course, the Central Debt Management Office at the Eurozone level will control how many red bonds can be issued by a particular country. and therefore that will control how much of your debt gets linked to the banking sector of your own country. The remaining bonds, which will be blue bonds, to borrow Jan's word, will be anchored outside of the domestic banks. In case of Eurozone, this would actually mean the entire Eurozone banks, which is that these bonds of the sovereign will be held by non-banks. What is the purpose of this? The purpose of this is for this debt to become bail-inable debt. Okay, the purpose is that if the sovereign gets into trouble, you want to be able to take down losses on this kind of debt. Now, as expected, coupons on this debt will be higher. The country can choose how much of this debt they want to issue, because it's not going to be backed by the Central Debt Management Office of the Eurozone in particular. And actually, the Bruegel proposal goes exactly in line with the Likkonen report, which is to say, reward the politicians with your blue bonds. Okay. Which is that if they make excessively risky debt, let them be the first in line to suffer from the losses on this debt. And now this will create the incentives where they don't actually engage in fiscal expenditures beyond a point that is simply unsustainable for the economy. So don't fund your fiscal expenditures with debt up to a point where this debt becomes very risky, and you get them to internalize it by giving them these blue bonds. So my sort of main point of departure from our central focus on financial sector regulation is that I think governance of governments has also gone completely out of whack. And I think one reason why we are in the deep mess we are in is not just because of the financial crisis, but it's also because of the excesses of governments. And perhaps some proposals like this need to be footed on table so that we just don't have a treaty that's supposed to say things and keep everything in check, but there's actually some incentive mechanisms in the kinds of debt you have and in the kinds of incentives that those who run the governments have to actually be subject to the terms of these treaties in the first place. Okay, let's stop there and we can take questions. You can direct them to either of us, or maybe we'll all jump in.
Harold Benning from Professor at Tilburg University. This is, of course, a fascinating discussion. What Jan-Pieter Krahnen was saying, this whole issue about too big to fail, and that's, of course, a very valid point. Because of the fact that there is government intervention, that the government may rescue a bank, a large bank, when it enters into trouble, you get distortions, and it means that market discipline is not working appropriately. In that sense, that's also the beauty of the COCOs, I would say, that not only that you can have a leverage ratio, and when COCOs can play a role as part of it, you can be more ambitious in terms of raising bank capital, but you're also reinstalling market discipline. But the other thing is, of course, is the question, what is the type of banking system we want to protect as the government? Do we want to protect retail banking, or do we want to protect investment banking as well? And in that sense, I have a question to my colleague, Professor Krahnen, is that what you were saying, if investment banking activities like proprietary trading plus market making can have it also, what you were saying, it may have an artificial profitability because of the insured funding, the too big to fail by the government. You could also say, well, let's separate all of these activities, all proprietary trading and market making activities, from the deposit bank, so that meaning there is no government intervention at all. In my preliminary assessment of the Likkonen report, and also what was reported in the Financial Times, now you get a very complex situation. Below a certain threshold ratio, banks may still, the deposit bank, which is insured by the government, may still have these activities on its books, and otherwise you have to separate. But it creates, again, just like in the Basel arrangements, very complex games where banks can try to play around, to manipulate. So why not go for the other one, say, well, this is not perhaps the type of the part of the banking system we would like to protect as part of the safety net. So why not have all these activities in separately legal entities? Thank you.
I suggest we take a few questions first, and then we can respond to them at once. Maybe we can have 4 or 5 questions.
There has been a lot of discussion about, anyway, my name is Martin Botter. I'm working for a part of ING Bank. It's the first to introduce myself. There has been a lot of discussion, debate about the billion bonds, and when you read all the discussions in the media, the main criticism against banks is that they actually let the consumers, the people in the street, pay for the risk taken by banks. If you look into the blue bonds that were suggested by you, who are actually prepared to buy the bonds out of the non-banking sector, because the real industry corporates, they will use their capital for funding their real economy activities. So they're not going to use their funds for investing in those bailout bonds. So who are the parties that are left? I think pension funds, which are finally retail consumers, or maybe investment funds or mutual funds, which to a greater extent are also held by the same consumers as a part of securing the pensions or securing other revenue to support their financial needs. So my doubt, my question is this solution finally going to solve the problem we all intended to solve?
Hi, my name is Richard Schreuder. I work for an investment fund, and I try to make sense of what happens with the shares in financial companies. And for a while I asked the managers of financial companies whether they got visits from the local regulator to check the documentation and underwriting standards. And actually there were very varied range of responses to that question. The Danish banks get very regular visits, I get the impression, and maybe that also explains why there's never been a default on a covered bond in Denmark. And I'm not going to mention other countries where I got the impression that there were hardly any visits from regulator looking at underwriting standards, looking at documentation and documentation checks. I'm not saying this is going to prevent the crisis at all, but I think it is an essential element, and it's probably a boring element, but it's certainly one that needs to be looked at.
Yes, Marcel Klopper, Capital Management, ABN AMRO. I have more of a general question, which is why not, except for, of course, for DGS, make all of the capital structure of a bank bail-inable? Because, and then, in my view, the problem is solved, theoretically, of course. And if not, then I wonder, because you're now only proposing in the Liikanen report to make part of the capital structure bail-inable, have you found out what the optimal point is in that? Because in fact, the question is, it's either the taxpayer who pays, or it's the creditor who pays. Basically, the taxpayer is mostly the worker, and the creditor is mostly the person who has the money and has been retired. So it's also a question of how do you distribute wealth. Have you done any thinking about that? Because these are political choices, and otherwise they're also a question of what is most efficient from a society perspective.
The first question was on separation. So is the separation, let's say, route that the proposal contains doesn't say any type of trading is basically has to be separated, and there is, so to speak, a de minimis rule in this proposal. We didn't fix exactly the level. That's something anyway. These calibration exercises will still come. The Commission will have to do that. We only suggested a certain region, so to speak. But the basic idea is that the idea was not to break artificially up the universal banking model that has been successful in Europe, but really to cut it at that point where we feel that a lot of additional risk is being generated for the sake of exploiting returns that go with additional risk. This is not true if I basically accompany a company in its attempt to do some foreign exchange financing. So this type of businesses that go along with some trading, which is basically in line or aligned with client business, that shouldn't be. That is not where we see the main risk up in the build-up of risk in the system. So we thought we make a simple rule, which is a size-related rule, to basically cut out the major players in this market. If you look at the statistics, they are in the report, you will see that if you cover something like the 50 largest banks that were mentioned, you get most of those, the trading books out. There's something left, and this something is small enough that we don't think this poses a big threat.
Yeah, why don't I take the question on the blue bonds? Yeah, I guess the question with bail-in debt and blue bonds is who will buy them? I think that's a very good question. I think we have to let the market sort of evolve. And I think if there is no one who's willing to buy, it means that there is no debt capacity where you can actually pass the risk. And maybe therefore there should be less leverage in the system.
Can I add on this?
Yeah.
I mean, this was, of course, an issue we were concerned with a lot, right? So is there any guesswork to be done whether there is a market? And the first argument you hear when you come with the idea of bail-in debt is there is no market for this. And so there are a lot of things one can say. One thing is the Swiss, you talk to the Swiss and they will talk about their success in that. And from the Swiss side, you hear a lot of optimism that this market will eventually evolve. What is always needed, that is the message that we got from a series of interviews, the product must be well defined. So it must be clear that the market has to price a particular sort of bonds. Right? So in that sense, we always stress there is one layer of debt in the banks that will be bail-inable, which doesn't say that the rest is basically sacrosanct. Right? The rest might also be bailed in, but it's to a certain extent subject to the same type of uncertainty about uncertainty that we now see for the entire capital structure. We didn't put up a real number, but the number that is in the head of many of us is something like the Swiss model, which would basically be of the same order of magnitude as equity in the market. And for that, you can guess or you can calculate how large would the market be. And to be more detailed, the market in that sense for European banks would be in the order of magnitude 1.5 billion for bail-inable debt in Europe, which is a significant number. Right? So high-yield bond market is way smaller in Europe, not in the US, but in Europe. So you would see emerge a particular high-yield bond market that would be able to cover that. But, now comes the but, you can lower that size if you structure the bail-inable debt. Right? So that would be phase 2 of that debate, would be how we make it fly, and that would probably go along with the structuring of that layer into, let's say, 2 layers. One that is takes the first hit, which is certainly high-yield bond, and the second one, which can be investment grade. Right? So you could basically solve a little bit that problem.
I think there's a point of principle here as well, because you mentioned the question, how does this relate to the organization, society, the distribution of losses, and also a question of principle on financial stability. One of the most important things, I think, is to create certainty in markets, or to avoid creating undue uncertainty. And if you give a regulator or someone in Brussels or whatever an extreme power to bail in whatever element or the whole liabilities structure of a bank, if need be, that would create an immense amount of uncertainty. I'm concerned. In the Netherlands, we have 480 billion of wholesale funding to our banks. Our banks are heavily funded because we have such a large mortgage book which they cannot fund from deposits in the Netherlands. So they have to go to the markets. And if we introduce this uncertainty in the markets, it's going to create contagion risk, and it's going to create uncertainty rather than providing guidance to the market on what is bail-inable. And that's why I have very great sympathy for the proposals in the Krahnen report, which says it's going to be a fair system because there will be bonds that are issued and for which ex ante there will be a statement that these are bail-inable, and if they get bailed in, you were told very explicitly at the outset that this could happen. But now suddenly introducing a new bail-in powers, which is in the proposals by the European Commission, would create enormous uncertainty in markets and I think even systemic risk.
Yeah, if I can come to the question of supervision, I tend to agree. I'm concerned about the over-reliance on ratios. I think it creates a very tick box feeling to supervision of banks that you take the numbers they give you, You add them up, capital looks right, tick, done. And I think that's just not how you would invest your money if you had to invest in a particular company. You know, if you had to write a credit report of a particular bank as an analyst, you really wouldn't approach the problem in this manner. And I've actually had some discussions with regulators in the US and proposed that they should actually write very detailed credit analyst reports, the way a credit analyst would write for an individual firm. That they should actually write a credit report on Citibank, they should write a credit report on JP Morgan, and with 1 quarter's lag, it should be made public so that the supervisor is accountable. Of course, that's never going to happen. But I tend to agree that...
Can I comment?
Yes.
Can I comment on that?
Yes.
I mean, this sounds to me similar to the idea we should do stress tests every other week and publish the results, right? And I think we can visit in Europe very well. EBA has almost lost its reputation, at least risked its reputation, because it made this commitment. And everybody in the market understands that they are basically tricked in a way. Why? If you announce you will do a stress test and you will publish the results afterwards, which would be basically your suggestion, you put that institution that makes this commitment under heavy stress itself. Because let's assume it makes a stress test, and the result is devastating for whatever reason. It knows in the moment of publishing it, it creates the systemic crisis it exactly wants to avoid. So because this logic is known to everybody, what does the regulator do? He asks first the banks whether this stress scenario is still bearable or not. Right? So, and so then the stress scenario which we will be publishing is one where we know in advance that it will be okay. But since the market also understands this, they don't trust that stress scenario anymore. So you are basically completely out of, you do it, but nobody believes in it. Nobody from both sides. And that would be similar, wouldn't it?
Yeah, but let me ask you a question, Jan. Suppose you didn't have to release the stress tests. Would the regulator have done anything different? If they knew that the system is in stress, they would do exactly the same thing. Because eventually down the road, the bad news is going to hit the market.
No, but they can use other criteria. If the stress test is completely silent, it's not published, then they can use any criteria they find interesting. And they learn something from the stress test. Now they have to anticipate that markets will respond and have already put this into the stress scenario, which makes it basically invalid. That's my point. So I think
Yeah, so I guess my sense is that it's the same forbearance. The forbearance that you are trying to avoid is now happening through the stress scenario. But as long as it's transparent, there is greater accountability for it. So my worry with sort of a supervisor never releasing to the market what's happening is that there's no accountability. Now they can just say, what were the losses on your mortgage book? Oh, there were no losses. And there's no accountability at all. Whereas if you at least chose a very relaxed stress scenario, so take the stress tests of the US, the second stress test, which was very, very benign. They declared it, banks looked very good, but then a lot of people jumped up and down saying, you know, this stress test didn't make sense. It wasn't very stressed. So that creates a little bit of feedback on the regulators where they can't just turn a blind eye and not be subject to any questioning. But, you know, wanted to respond to the last point.
Right, to the stress test point. I think the fundamental point is the absence of a public backstop for the stress test. So we designed a stress test in Europe, but we didn't agree with each other beforehand that if banks had a shortage, that there would be a backstop that would be in place and that would fill this shortage. And if you don't have a public backstop, then you're going to be less strict in your stress test because you can't resolve it. And that's why the banking union would help solve this, because that would be the backstop.
But I guess the other option would be just recapitalization or a resolution program. Right? So once you're at bail-enable debt, you don't need the backstop.
Yes, but you need time to. You have to issue these bonds and.
Yeah, the last point was on why not make everything bail-enable, and strictly speaking, that is the idea of a living will, that one by one every tier comes down and eventually everyone could take losses. it somehow felt that depositors shouldn't take losses. It's a very raging debate in banking literature. I don't think in policy space anyone is asking the question of eliminating deposit insurance altogether. I think Charlie Calomares from Colombia would actually say that the introduction of deposit insurance was the time when depositors stopped caring about their banks. There's an interesting proposal in Raghu Rajan's Fault Lines book where he says, don't give deposit insurance beyond a certain size of a bank. So rather than putting it on the level of size of an individual account, the idea is don't give it beyond a certain size of deposits. And so the idea is that now if a bank is just growing large on back of a deposit insurance, maybe because they are adding a trading unit to it, which is implicitly getting subsidized through the cost, they can't keep doing this indefinitely because beyond a certain euro amount or dollar amount, the deposit insurance doesn't extend for the bank as a whole. My sense is in current environment, it's very unlikely that depositors will be asked to take losses. There's already quite a bit of risk aversion in the markets. But theoretically, I agree that we could make it bail-enable in sequence all the way down. I think we have to stop. So if there are other questions, maybe we'll wait outside and we could discuss them. Thank you very much. Thank you to all the
I would like to end with one interesting thought, which I think Viral touched upon, which is to actually look at banks. Who would do this? I don't know. But to look at banks in the way that banks look at their lending clients. In other words, as you have mentioned, to go in when a bank looks at whether it will lend or what, it looks at the who's in charge, what is the strategy, what are the type of assets, liabilities that it already has. It's very micro, but I wonder if that's something to be looking at for the future. And this comes from, let me say, a completely outsider's perspective compared to the experts up here. One Dutchman here, and the rest are coming from abroad. Thank you very much, Viral.